Savings and loan associations. Like commercial banks, saving and loan associations (S&Ls) accept deposits, make loans, and are owned by investors. Most S&Ls were created to encourage savings habits and provide financing for homes. They did not offer check services. Traditionally, they loaned money primarily for home mortgages. Many of them, however, have ventured into a variety of other investments. S&Ls in the United States now hold $1.5 trillion in assets and deposits of nearly $1 trillion. Mutual saving banks. In mutual saving banks, all deposits are considered owners of the bank. All profits, therefore, are divided proportionately among the depositors who receive dividends. Like S&L's mutual saving banks attract more of their funds in form of their savings deposits, and funds are loaned out in the form of mortgages. Mutual savings banks and S&Ls are declining in number. From their peak of 4,800 in 1960s, today some 1,400 are operating. Several factors have reduced their ranks, especially in the sharp interest rates increases for savings in the 1970s, while long term loans were locked in at lower rates. Revenues from loans could not keep up with the rising interest payouts for savings, resulting in financial failures and closures. Credit unions. A credit union is a non-profit cooperative financial institution owned and run by its members. Its purpose is to promote thrift and to provide members with a safe place to save and borrow at reasonable rates. Members pool their funds to make loans to one another. To join a credit union, one must be either one must be eligible for membership. Each institution decides who it will serve, such as a group of employees, people in particular community, or members of an association. Most universities, for example, have credit unions, as does the US Navy. Credit unions make loans for automobiles and home mortgages, as well as other types of personal loans. Currently, 9,500 US credit unions serve nearly 82 million members and hold more than $500 billion in assets. Not deposit institutions. A variety of other organizations take in money, provide interest and other services, make loans. Four of the most important are pension funds, insurance companies, finance companies, and security dealers. Let's talk about all of them in detail, one by one. Number one, pension fund. It is essentially a not deposit pool of the funds managed to provide retirement income for its members. Public pension funds include Social Security and $2 trillion in retirement programs for state and local government employees. Private pension funds operated by employees, unions, and other private groups cover about 90 million people and have a total assets of $7 trillion. Insurance companies. They collect large pools of funds from the premiums charged for coverage. Funds are invested in stocks, real estate, and other assets. Earnings pay for insured losses such as death benefits, automobile damage, and healthcare expenses. Finance companies, number three. They are not deposit institutions that specialize in making loans to the business and consumers. Commercial finance companies lend to the business needing capital in long term funds. They may, for instance, lend it to the manufacturer that needs new assembly line equipment. Consumer finance companies devote most of their resources to small, non commercial loans to the individuals. We'll talk about the fourth entity, security investment dealers, brokers, in our next video.